This week we are sitting at an extremely pivotal point for the market, so I figured I would provide a technical update to the S&P 500 index. I'll be using the market profile and trend lines to do so, no fancy indicators. Also, I'm going to be showing an SPY chart because my futures chart is pretty cluttered and I don't want to delete everything. Let's get into it. First of all, let's talk about my last public update in which I provided levels with a high probability of being long-term bottoms. The main takeaway there was, when fishing for a market bottom, you have to determine which support levels are the strongest on a long time frame like the weekly or yearly, and then you have to assume each one is the bottom until that actually happens. Getting too attached to a singular level or point you believe has to be the bottom is a common mistake and a recipe for missing out. In this post, the first of those likely areas I mentioned was this 35.93 to 34.98 zone. For the last 3 months, that has been the bottom, and like I said, we have to assume it remains so until proven otherwise. So what counts as proven otherwise? Well, put simply, we have to get under that level, but there are some leading indicators I'll be on the lookout for in determining the likelihood of making new lows. The first of these would be breaking down this red trend line on the daily chart at 377.90. This is what I'm referring to as the midterm uptrend. It also marks the bottom of that bearish consolidation we broke to the upside most recently. Usually, a break back into consolidation after breaking out of it results in a violent directional move. This is known as a false break. Upon breaking that trend down, there is not much for swing support until we get back near those lows. Furthermore, that would mark the third time we are testing that key demand zone that stems from the highs of the presidential elections. Usually, each time we test an important support, it's less likely to hold again. This is why it isn't a stretch to surmise that the next time we attempt the lows, we break them. And as a lower price target, I would zoom out to the weekly chart and plot a trend connecting the two most recent lows. That would land us right around important support on the 5-year profile at 340.23, a reasonable target. Next, let's talk about upside scenarios. Right now, we are on the verge of breaking the single most important trend for the entire S&P 500. It's this purple trend that makes up a massive broadening descending wedge, which is the largest bullish continuation setup in many years. For those who don't know, a bullish continuation setup is one that stems from prior upside and indicates after a period of grinding downwards, the market will continue to new highs. This breakout point is sitting right on 400.23 as we speak. Technically, we only need a weekly close over that line to secure a breakout from this massive setup, but I would prefer a monthly close given its magnitude. I also would prefer us to close the week over this important level at 402.20 as it would provide a base for us moving forward. Technically, a setup like this would target 525 to 550 in 1 to 2 years. However, that's a long ass time and a lot is going to happen in between. Immediately after, we have key resistance at 424.43. This would be a great point to see the market flag out and project above the breakout on a lower time frame than the massive pattern. This is the healthiest way to start a major change in trend. There's also one more wild card I want to keep an eye on. Remember that lower line we plotted at the beginning of the video? If you plot that line on the high end as well, you can see this actually makes up an entire pattern known as a broadening wedge. This is a completely separate structure with a bias towards sideways movement with expanding volatility, and I want to be especially cautious of the high-end post-breakout because it lines up perfectly with this 473.32 level that has confluence with the 5-year value area high. So, once we get there, I'll be very cautious until we clear it and also load some put swings. This is the last thing to clear to be out of the woods. Rather than thinking of this breakout as a sure thing like, oh yeah, we're going to 500 plus no matter what, you should think of it as, okay, the market has a bullish bias as long as we are above this trend and dips are buyable. The last scenario you want to keep in mind is, what if the market breaks out and then breaks right back into the pattern? Well, this happens, and it happens more often on patterns that are this high profile. Remember, this is known as a false break, and these often result in violent directional moves. In this case, to the downside. So, to summarize, SPY is on the verge of breaking its most important trend line, and it needs over 400.23 this month to do so. Price targets on a breakout like this are 525 to 550 within 1 to 2 years, but you want to keep your head on a swivel and play the small moves in between. Until then though, the long-term trend is decisively down and we are biased towards yet another rejection. Watch for a break under 377.90 as a signal to look for new lows. Thanks for watching, guys, and if you enjoyed this style of video, please let me know in the comments and leave a like. Also, don't forget to subscribe so you don't miss any updates.